Hi friends, welcome to Hemant YouTube channel. Today we are going to learn different ratios in mutual funds. There is a X mutual fund. It has said that it has found out a new loophole. That is, it takes money from the public and it says the we shall increase the expenditure by 5 to 10% and we shall pass on to the unit holders. He said, due to this, what happens? Due to this, cash balance will fall and that money will go to the mutual fund. Yes, like this happened in 90s. So, SEBI came with a new rule, that is expense ratio. A mutual fund should have certain expenditure in its NAV. Suppose mutual fund SEBI says 2.5% it should be on NAV. Suppose your NAV is 100, your expense should not be more than 2.5. Then mutual funds came and said, I am paying brokerage. Brokerage is 0.05% and while trading in the session and GST, IGST, all are expenses. You said 2.5%. How to pay to the manager fee, administration fee, how to pay to the technical persons, how to go for technical like computer knowledge person, because nowadays nowadays or every time mutual happens with in electronic, not in physical. I have this much expenditure and moreover brokerage is costing more for me. Then SEBI said, okay, reduce that expense. Except brokerage, all expenses should be within 2.5. So expense ratio includes all expenditure except brokerage. So it is a percentage of assets that were spent on a mutual fund. Simply, what is expense ratio? Expense on NAV. So expense divided by NAV. Which NAV? Opening or closing? Average of NAV. So ratio equal to total expense except brokerage divided by uh, average expense. It includes all costs except brokerage. This is also known as management expense ratio. Why? Here brokerage is excluded and all expenses are for management. Management fee, admin fee, other expenses. So these are managerial expense ratio. Suppose a mutual fund handles 10 lakh assets. It says I have 10 lakhs asset and it says I'm 15,000 I want as fees because I am getting charged. I'm paying for a manager. I'm incurring huge admin charges and technical charges session. So here expense ratio equal to expense divided by asset. Asset or average NAV. So 15,000 divided by 10 lakh equal to 1.5. It is a regulation by SEBI. Next, Sharpe ratio. A friend came to me and said, hey man, I'm going to invest in mutual fund A X because it has given higher return when compared to others. Okay, I asked how much return it gave. He said, how it has given 15%. Okay, and I asked how was the market performed during the last year. It said it's performed absolutely in a bullish manner, and market has increased beyond limits, as he said. Then I asked, in past 2 years, how much return he got? In past years, how much return that mutual fund has got? Then he checked and said, for past 2 years, it got only 5%. I asked, in past 2 years, how was the market? In first year, it was bearish, and second year, it was bullish. So he said, last year it gave 11% for me. I will choose, last year it has given 15% for me. I will choose this only. But here risk is there. Yes. What is the risk? There are so many types of mutual fund, and in mutual fund there are many. One, they purchase assets, they take the risk, huge risk, and the risk includes loss. So one mutual fund invest in risky stocks. If risk is positive, they get the return. If risk is negative, they get negative returns. And there will be some type of mutual fund where there will be moderate risk. They never invest in out of Nifty 500 or Nifty 100. They always invest in Nifty 100 or BSE 100 or Nifty 500 and BSE 500. But there are some mutual fund which invest in beyond Nifty 100, beyond Nifty 500. It is risky. Why it is risky? If it was Nifty 100, we are assured that that stock will not fall for 5% or 6%. 100, not 100%, but at least we have a probability that it will not fall. When it comes to other stocks, it may fall to 300% or it may increase up to 300%. There are no limits. For example, Suzlon Energy. I think it has fallen from 90 to 3 rupees. And S Bank 250 to 13 rupees. So, mutual fund take risk and pass on to the unit holder. He said, I am going to invest in this mutual fund because I have got 11%. Then he has taken other mutual fund which is moderate, which always invest in Nifty 100 and BSE 100. That return is 10%. He said, this mutual fund is benefit. I said, you cannot say like that because risk taken by first mutual fund is more, so you will get higher return. Whereas risk taken by second mutual fund is low. So it got better benefits at 10%. He said, how to choose, how to say, I have taken this much risk and how much return I got for one risk. For example, he said, I have taken huge risk. Risk includes both systematic risk and unsystematic risk. And I have got this much return. How to compare? He said. Then the Sharpe ratio is used. Sharpe ratio of a mutual fund reveals potential risk adjusted returns. What is risk adjusted return? For example, X mutual fund. Its standard deviation was 7%. That means standard deviation 7% means suppose it has got return 7%, at probability that it may vary from the portfolio return is 7%. Now standard deviation is 7% for that mutual fund, and whereas actual return is 15%. Actual return is 15% and risk-free rate return is 6%. So it has got 9% more than risk-free return by taking the risk. So this Sharpe ratio says that the difference between risk-free return and risk-free return divided by standard deviation, we get the what is the risk per standard unit. The Sharpe ratio of any mutual fund can be easily calculated using a simple formula by following the steps. Subtract risk-free return from the portfolio return or average return. Divide the subtracted return with excess return or by standard deviation. What is standard deviation? Deviation reveals the how investment return varies from the principal return of an investment. We know standard deviation. Standard deviation is nothing but the risk. It includes both the unsystematic risk and systematic risk. It measures the risk. For this much risk, I got this much. For 1% of risk, how much I will get, this ratio will say. This is Sharpe ratio. Suppose if Sharpe ratio is 1, It says risk rate is very low. When Sharpe ratio is 1 to 1.99, risk rate is high. When Sharpe ratio is 2 to 2.99, risk rate is high. 3 or above, risk rate is high. How can we say risk rate is high? Standard deviation is nothing but the total risk. Suppose we assume standard deviation as 1. And the difference between risk-free return and it has got is 0.9. So here Sharpe ratio is 9:1. 0.9:1. Standard deviation is more. That means risk is comparatively low, but return is poor. So it is waste. When it comes to second, Sharpe ratio is to 1 to 1.99. Here risk rate is, that means ratio is high and returns also high. So it is good. Sharpe ratio 2 to 2.99, risk rate is high. It returns also high because difference between RF and actual return is more than the standard deviation. Why it is important? It helps in recognizing the risk level. How much risk I am getting, how much return. When compared to other risk-free returns, it says. It helps in fund comparison. Absolutely. Suppose there are two mutual funds which take the risk, and for per risk how much return we get, we can easily calculate. Trainer ratio. This is third ratio. This was introduced by Jack Trainer. Previously, in that ratio, we includes both systematic risk and unsystematic risk. But in Trainer ratio, it includes only systematic risk. Here, systematic risk is known as beta. For 1 beta, how much return we get, this ratio is useful. Beta is equal to risk-free return plus K equal to risk-free return plus beta into return of market minus risk-free return. So Trainer ratio helps for how much 1 beta, how much return we get. How is the Trainer ratio calculated? Simply, first subtract actual return with the risk-free return divided by beta. We get Trainer ratio. Suppose Raj is comparing, saying that the X and Y is there, two mutual funds is there. X invest in only equity, Y invest in only fixed income fund. The rate of return of X is 12%. R equal to 12%, whereas for Y R equal to 7%. Beta for Y is equal to 0.5 because risk will be lower as I will get compulsory return as I invest in bonds or in treasury bills. For X, beta will be more because he will not get a compulsory return and he may get negative return. It denotes that 20% risk is more and Y 50% less is there. Let us let's assume risk-free return as 2%. For X, Trainer ratio equal to 12% minus 2% divided by 1.2. For Y is equal to, X equal to 8.33. For Trainer ratio of Y equal to 7% minus 2% divided by 0.5. Here 7% is R, 2% is risk-free return, 0.5 is beta. So for 1 beta is getting 10. For 1 beta is getting 10%, whereas here assuming 1 beta is getting 8.33. Without calculating this, we can say an unknown person can say X is given better return because it has 12%. Y is giving less return because 7%. No. Y is better because for given 0.5 risk, it is giving 7%. Whereas by taking 20% more than the market, 70% more than Y, it's giving only 12%. It has to give beyond 12%. then only X is better. So trainer ratio helps in comparing the mutual fund. For one beta, how much return we are getting, we can say. So what is the main difference between trainer and Sharpe ratio? See, trainer ratio includes only systematic risk, whereas Sharpe ratio includes systematic and unsystematic risk. Trainer ratio is useful when systematic risk. Systematic risk is available when portfolio is diversified. So trainer ratio is useful when portfolio is diversified. Sharpe ratio is useful when portfolio is not diversified. It measures the risk adjusted returns of portfolio based on its beta. Beta here on the basis of beta, here in the basis of standard deviation. So the main difference is beta, standard deviation, portfolio diversified, portfolio is less diversified, systematic means unsystematic risk. Thank you.